Hello everyone, welcome to Grow Your Future. I am Chocolate Daddy and this is my co-host Vanilla Ice.
How are you guys?
What an intro.
What an intro. How did we get those nicknames? Please tell them.
I think because of our skin colour.
Oh wow. We went there.
What are we talking about, huh?
Well, today's a good one and I'm really excited for today's podcast. Because this week something interesting came across my desk where I've had two clients come across with their scenarios and they're looking to do a plan with real estate, but their current position doesn't match a long-term plan with what they wanted to achieve. So today what I want to uncover with your opinion, and we'll go through mine, is how you go about creating a property strategy or plan that actually works for what you want to achieve.
I see it all the time. Like people coming in, they've got this strategy in their mind, and they're like, "I know this is the thing that's going to work," and sometimes they actually go and do it, and then they ask for my opinion, almost looking for confirmation that they've done the right thing. But sometimes it's a little too late because they've already done it, and as we know, real estate is a illiquid asset, so it takes a long time to liquidate and sell, right? So, it's a common thing where people think they're doing the right thing. And how I know this is I went through it myself, where I thought, okay, I know what I'm doing. I think I know what I'm doing. I go out and do it and then realize 2, 3, 4 years down the track that I've probably not made the best decision. So it's really important to get it right from the beginning, or as right as possible for that decision in time, because it's really, really hard to unravel later on down the track.
Awesome. So let's go into what we would say builds a large property portfolio. And I think there's 4 major points which you can consider before you actually go into picking a property or whatnot. So the first one we want to look at, and I think is really important, is the psychology that goes into play. So we'll bounce back about what your psychology is being older and with the experience, and mine with my education and my position. So what would you say would be the number one thing from a psychology point of view that goes into building a portfolio? So
psychology is all about mindset, right? So getting around the fact that you've got to spend money to make money. A lot of people feel it like it's a really big burden to invest their money, and they sort of feel like they've lost that capital, when in actual fact they've invested it, they've parked it somewhere else other than the bank, and they've put it into an asset that potentially is going to increase in value, right? So the whole psychology starts with, okay, the savings mindset. So making sure that you put as much money away as possible, but then you're comfortable with parting with it because you've educated yourself as much as possible in terms of pushing it into something that's going to grow in value. And then going beyond that, building a portfolio of assets. So keep going rather than just stopping at 1 or 2, which is what most people do. And we live in an era now where we can't build portfolios of 10, 15, 20 properties anymore. It's just impossible with the lack of access to credit at the moment. So what we've got to do is we've got to make sure that we select the right properties in the right locations that fit our strategy and our situation. So the first step would be to get your mindset right. And a lot of people don't get past that first point. And you said something very interesting before, where you've educated yourself a lot on it, and I believe that's your first step.
Exactly right. And I think as well for us younger listeners and younger people in this generation is that we grew up in an era where we've been taught to go and pay things on credit, or really we've been brought up in a society where we're wanting to get things, be rich quick. And I think I've fell victim to wanting to just make money without having an actual plan that I can, if I just follow this plan, it will make me rich for sure, rather than get rich quick. And I think an example that my friend brought to me yesterday was he wanted to buy a property and do an Airbnb strategy. Now, if we to look at the Airbnb strategy, it works to make cash flow in the short term, but what's the long-term effect of having that asset? Is it going to grow in value? Are you going to be able to use the equity to then build a portfolio that you wanted to create? I guess the psychology from my point of view, it's like we need to be mindful of enjoying life today, but also creating a good future down the track.
So it's all about the long game, right, Dan? So it's a good example to use because a lot of people tend to go for the get rich quick, what's happening in the next 2-3 months or 2 minutes. A lot of people are just really, really short-sighted. And what happens is they don't focus on that long game. And it's very easy to get caught up in what's happening today and what works today. Airbnb, short-term rentals. Are you going to get the high yields now? Like the mining towns. A lot of people go and invest in mining towns when it's running hot and they're getting the 12, 13, 14% returns. But then when the mines start to decline and workers leave that area and there's no more demand, those properties go down in value because they've only seen the next 1 year, 2 years in front of them. So it's really important to get the psychology right, going, no, hang on. This is a long-term play. Like we're talking 20, 30, 40, 50 years time. We're going to live for a very long time. Like you young guys, like you've got a long time on this planet before you go. So what we want to do is we want to think about, 50 years down the track and go, okay, what are we going to invest in today, which we're going to be really happy with our decision 50 years down the track. Let's not invest in something today to Airbnb it so that, next month we're feeling good about it, right? Let's invest in something today where we go 10, 20, 30 years time, we're really glad we made that decision.
And it's an interesting point as well because with property, where the wealth is actually made, we see is through the equity gain. And I think where people go wrong with the Airbnb strategy is that when you do make that higher rental income or that income from the Airbnb, you're getting taxed on that from day one. Where if I have a property that grows in value, I can actually draw that equity and not pay tax on drawing the equity. I just pay a 2 or 3% interest rate based on what the current interest rates are in lending. So it's an interesting point that you've got to consider, and especially if you're looking to do developments down the track. When you do a development, a bank wants to see, or a lender wants to see your equity in a deal, not so much how much you can service. Because with development finance, a lot of the times you're capping the interest or not actually servicing it monthly. The bank will give you your, say, $1 million or $2 million to do the construction, plus they'll give you money that they use for interest. So you don't actually pay the loan off. They give you all your money, you do the development, and then you sell whatever properties you need to be sold to pay them back. So I think if you are someone who wants to get into development, don't focus on those cash flow properties. Focus on building a strong portfolio that can service itself, but gives you that equity so you can tap into that equity to go and do your development. So that's something that the problem that I saw this week was this guy had 7 properties at such a young age, but none of those properties were good growth properties that he could then use that equity to do that development.
So it's a good point, Dan. It's a good point because a lot of people focus on the yields because they're worried about today, right? But if they focused on building a really good asset base that had some sufficient equity in it, then if they want to do the bigger deals like the developments and all of that sort of thing, the banks look at that as collateral. And they go, look, if this thing turns to shit and, it falls over, it's all good. We've got something to claw back. Like at the end of the day, banks want guarantees. They don't want cash flow. They just want to know that, they can get something if something turns bad. And that's where that equity is really, really important to have. And like you said, this person that you've been talking to who has all of these cheaper properties in his portfolio, they provide a great yield, but it's not hard to get a good yield these days. Like really, it's not. Like we are in a very low interest rate environment. We've got loans sub 2% out there in the marketplace. If you get a yield of 2%, you're doing well.
So what would you recommend would be a good plan or strategy or system for someone starting out? Like say you're recommending a 10-year or 20-year plan, what would yours be?
So I would always recommend accumulate as many assets as you can, right? Have a diverse portfolio, it could be apartments, townhouse, house and land, maybe throw in a couple of developments in there. And spread it out across the nation, preferably between Melbourne, Sydney and Brisbane and those secondary markets, like those regional markets like Central Coast and Newcastle. If you're spread out and diverse, and you have those different types of asset types, I think you'll do quite well. And what we've got to remember, as we previously said, we can't build that large portfolio anymore in terms of really sort of scaling 25, 30, 40 properties. It's just too hard for the average person on a normal income. So what we've got to understand is, okay, we've got limited opportunity to buy certain types of assets in different markets that are probably going to outperform the other, right? So what we want to do is okay, a good rule of thumb is, say, if you want to buy 5 to 6 property, buy 2 in Melbourne, 2, say, in New South Wales, and 2 in Brisbane. And then you're well diversified, have a mix of apartments, townhouses and houses in there, and you're set. You know, that's your foundational point. And I think people get a little bit too romantic about it. They set their expectations a little bit too high and unrealistic. And what happens there is that it's easier to do nothing. It's easier just to actually not do anything because it feels like it's just too overwhelming. But if you set a realistic goal as your foundational goal, so that could be, say, 4 to 6 really good quality investment properties, and then go, okay, after I hit that 4 to 6, then I'm going to go to the developments. Then I'm going to go and buy my owner-occupier residency. Then I'm going to go and open my business, or whatever it is, whatever floats your boat, right? But what you've got to remember is that first 4 to 6 investment properties are critical. They're very important, because if you get it wrong, right, it's going to take a while for you to come out of it.
What are your targets on the assets that so let's say you're going to build a portfolio of, say, 6 or 5 assets. What are the targets you're looking for in each property on a general rule when you're picking the property?
It all depends on the personal situation, right? So for example, I'm buying more apartments at the moment because I'm focusing on yields. I'm wanting more of the income rather than that capital growth. So for me, I'm on the tail end of building my portfolio. You know, I've got 12 assets in there. They're all performing quite well. So for me right now, I'm not really thinking about doing a lot of house and land unless I'm doing developments. So for someone else, however, just starting out, it may be a different story. So it all depends. It all depends. Like, we always try and tell people to try and shoot for 10. You don't have to get to 10. If you get to 5, if you get to 6, at least you're in the top 1%. Like, the stats show that less than 20,000 people of the Australian population own 5 or 6 or more properties. Like, it's a very, very small percentage.
Yeah, I think it's 0.9% of our market own 6 properties or more. So
it works out to be about 17,000 people. It's really, really low. Now, when you think about it, going into this new era of low interest rates, you know, money doing absolutely nothing for you in the bank, it's actually now a prerequisite for the Australian population to strive towards at least 3 to 4 investment properties. At least. It has to be outside their home. They have to, because otherwise you're going to get left behind. You're not going to live the life that you really desire at the end of the day, because the pension age is rising, it's increasing, right? Superannuation, the average superannuation fund is, I think it's like $200,000 or $300,000 or something like that on retirement. That's not enough. Like, our money doesn't buy anything anymore. So we need to have assets backing us to help fund our retirement, which we're going to be living a long time. Like, the retirement age right now is 65 years old. Man, like, I know so many 65-year-olds that aren't old. Yeah. They're young people. They're still traveling. They're still looking after kids. Some of them have grandkids. They've got responsibilities and they want to live a good life. They've probably got another 30, 40 years to go, right? And even so, for us, when we get to that age, we're going to live past 100 because of medical advances and technology advances, all of that sort of stuff. Like, we're living longer. So we need money. Like, we're going to get to 65 years old and go, well, we've pretty much got another, that's like half time, right? So what we got to realize is we got to go, okay, well, at 65, if we want to retire and we don't want to rely on our job, we're going to need those assets. We're going to need those assets behind us. So I feel like, getting back on point, it needs to be a prerequisite that people at least have 3, 4, 5 properties on the horizon for them, because savings aren't going to pay them. You know, they need property behind them.
That's a great point, and I think as well, what I would like to share with you guys is maybe one of my strategy is, and I'd like to see your opinion on it as well, and we can bounce some ideas. And I think now with rates so cheap and the cash rate being so low, I think there's going to be a good 2 to 3, maybe 4 years of this cheap money. And I think with that cheap money means you can actually afford to go and buy something with a bit more capital growth because it will be positively geared. Now, the beauty with high capital growth properties is that when the property does take that increase and the yield stays the same, you're actually getting a higher return in the future because the property's gone up in value. So say, for example, I bought a $500,000 property and it grows at 7%. In 10 years' time, that'll be worth, say, $1 million. And then say the rental yield was 4%. The 4% on $1 million may end up being cash flow positive down the track. Say it's cash flow positive today, it'll be more cash flow positive down the track because the value is so high. Whereas if I was to buy a property today worth $500,000 that gave me a yield at 7% but only grew at 5%, then yeah, it's cash flow positive today, but in the future, that capital growth didn't give me that much equity, and the property I could have bought that gave me the capital growth will outperform that rental income. So it's an interesting time because I think we can maybe look to buying more capital growth properties when you have cheap lending for, I think, will be the next few years, and a lot of especially what you're saying where the debt, but people are going to be capping out, not being able to buy 3, 4, 5. They're not going to be able to build a massive portfolio. I think if you can get some high capital growth assets in your portfolio early on, then you'll be able to leverage that equity and then maybe go to buy your cash flow positive one.
Well, now is the perfect opportunity, Dan, because rates are so low. So before, people would shy away from capital growth because they think, okay, well, I don't want to be burdened with this high interest rate that I have to service. So for example, when I first bought my first property, the interest rates were like almost 10%, like 9%. Like it was a hard environment to be in to service loans because your rental payments weren't covering your mortgage, right? Yeah. Like it was a tough environment. So people were starting to steer towards that higher yielding stuff. Hence the reason why those mining towns started to boom, because they had, 10, 11, 12%, if not more, in rental returns. But over time, what people found was that those mining towns, they didn't grow in value in terms of capital growth. Actually, they were quite volatile. So what we want to do now is go, okay, let's take advantage of the 1.5%, 2% interest rates and go, right, let's buy in these premium locations that weren't cash flow positive back in the day. Like these blue chip locations that were returning 3, 4, 5%. And that was considered a low yield back in the day, right? Now, that's actually a great yield. And you're buying in premium locations. So for example, we're buying in 10 out of 10 suburbs in Brisbane. I'm talking like 3 or 4 Ks from the Brisbane CBD. And we're achieving 4 or 5% yields. So we're positive cash flow. We've got the capital growth aspects of being in proximity to the CBD, right? It's unheard of. It was never like this back in the day. Like I'm actually now looking at the assets that I first bought 10, 12 years ago and going, you know what? I'm going to liquidate those and I'm going to buy these new assets that are in these blue chip locations because I can now afford to keep them. And I'm going to get that growth that you're talking about so I can tap into that equity and put it into the next project. And it's a really good point that you made, Dan, because a lot of people focus on now on the 7, 8% yields that are going to give them maybe $2.75 at the end of the month so they can go to the corner shop and get themselves a treat, right? Whereas what we want to do is go, no, we want the 100,000, 200,000, if not millions of dollars of equity. So we can go hard and buy the dream home, do the dream development, build the townhouses, right? Because that's where, like you said, the real wealth is. The real wealth isn't in $2.75 down at the corner shop. Yeah. Right?
Exactly right.
Yeah, the real wealth is in the growth, in the capital growth, so you can keep going and keep moving on to bigger and better things.
So let's then break down what would be our Luxland's property. At Luxland, we've got a property selection, I guess, checklist. So let's break down for the listeners what would be a good checklist or a guide they could adopt to get some of those assets.
Okay, so we'll move into the fundamentals. So the fundamentals, there's 5 fundamentals, and the first one is location. Location is number one because, you know, in Australia, for example, everybody wants to be near the CBDs. So you've got Brisbane, Sydney, Melbourne. Our majority of our population actually lives within those 3 cities.
And it's a great point, and I think, because what I hear all the time is people who are so skeptical and saying, oh, the market's gone up this much, it has to drop. Like, especially in Sydney and Melbourne, the prices are so high, but you get all these people that are saying, oh, it's going to have to drop by 40%, or the media saying it's going to drop, it's never going to, prices can't keep doubling. But like you just said, if it's the most livable city to live in, people from these richer countries like Russia, China, who've got millions of dollars to go and pay outright, are going to keep boosting these property prices up. So I think with location, it's really important that you get an understanding of how it actually works, not just from a domestic side, but also how it's internationally a global market.
You need to have that global education and see where the demographics are heading towards. Like, it's really interesting when you see people from overseas and that have never actually been here before and they want to come here. Now, generally, where do they want to come to?
The top, yeah, exactly.
They want to come to Melbourne, they want to come to Sydney, and now Brisbane is turning into an international city on its own. So people know those 3 locations. They might know the Gold Coast, they might know Bondi Beach, they know those iconic areas, right? Now, because they know those iconic areas, generally speaking, when they migrate here to live, they gravitate to those areas. Number one, they know it. But number 2, that's where the work is. Like, they're not just coming here for a holiday. These are the people that are residing here, pumping money into property here to buy, to live, right? These people are coming to where the money is, where the opportunity is. They don't want to be in the sticks, right? Because there's no opportunity there for them. And we're talking about, you know, the mass population of the immigration of where they want to reside. So they're looking at Melbourne. The ABS are forecasting Melbourne to overtake Sydney, right, to over 8 million people in 30 years' time. So, you know, Melbourne, for example, is going to be the new New York. Like, if you tell anyone that you own a property in New York today, right, people will look at you and go, wow, you must be rich. That is what Melbourne's turning into. New York has a population of, I think, around 7 or 8 million people. That is what Melbourne's going to be like in 30 years' time. So if you could get into the market now, right, and buy an apartment, for example, in Melbourne for, say, 400 grand, wouldn't you do it? Because in 30 years' time, if it's going to be the next New York, right, how much would an apartment be in New York?
Oh, millions.
Millions, right? Only rich people own property in New York, right? That could be you in 30 years' time if you buy a property in Melbourne right now. That's only one of the properties that I'm thinking that is really, really going to be beneficial in your portfolio, like across the eastern seaboard. But that's a really good example. People are going, oh, it's going to drop 40%. You know, like, has it ever dropped 40% in 100 years?
No.
Right? The average growth rate in the last 25 years has been 6.8% for houses. For apartments, it's been 5.8 or 5.9%. Right? That's the average year-on-year growth that it's had in the last 25 years. Right? Why the hell would it drop 40%? Now, if it drops 40%, you can surely bet that it will gain 50% probably the next year, right? It'll catch up. We had one of the sharpest downturns in history last year because of APRA, who came in and put the handbrakes on lending, right? We had a really sharp dip. But you know what? If you look at our prices now, they're back up to peak levels. And we're only at the beginning of this boom. So what's going to happen? We're going to surpass 2016, 2017 prices within the next 3 to 6 months, right? So now's the time to get in. So what we want to understand is, okay, we all know that property is not going to go down. It's just, you know, headline grabbing news. That's all it is. So we know we've got to invest in property. So the number one thing is location.
So what goes into choosing the location?
we use a variety of tools for it, right? Because on a macro level, we've talked about Brisbane, Melbourne, Sydney, but then there's markets within markets. So it's not like every suburb is going to be investor grade quality. Like, for example, I live in the city where there's unlimited supply of apartments. So you wouldn't buy an apartment there because, you know, vacancy rates are high. There's an unlimited supply. It's not really going to be a good place to park your cash, right? But we want to invest in 10 out of 10 suburbs where the affluent score is so high that the weekly family incomes far surpass the average of the state. So we know that that demographic lives there, and then we know that that is the location where we want to be parking our money. There's a lot of factors that play a part in choosing a location, but generally speaking, it's where the affluent people live, and it's close to all of the infrastructure and amenity that affluent demographic takes advantage of.
Exactly right. And I think another point I'd like to add to the location is what you see happening in properties. It's very cyclical, almost like a property. We refer to it as a property clock, right? And for example, Sydney, although it is probably one of the top locations you could invest in, the yields aren't there anymore. Where if we look at markets like Brisbane, where we're investing for clients, you've got some of the 4 or 5% yields. So I think another point where you look at the location is, can we hold an A grade asset which gives us good capital growth, but is also backed by a strong, yield in the short term. So that's another thing we look at in location as well. So after location, let's look at another factor that is a fundamental, and I think that is capital growth. So how do we go about, we know we want to build a portfolio of say 4 or 5 assets we can hold in for say 10, 20 year period. What's a good capital growth number, or how do we go about picking assets that are going to give us that capital growth?
So there are 2 ways you can get capital growth. You can get it through manufacturing the growth through either renovation or development, construction, or you can do it through choosing the right market, right? And, you know, I like to try and do both if you can, because if you can do, let's say, for example, a renovation in a really good uprising market, then you're taking advantage of both factors, right? So, you know, for example, we used to do renovations on the Central Coast just before it took off. So we buy it at a low point, you know, at say $500,000 median house price point, put $50,000 in it, but by the time we've finished the renovation and we've gone to refinance the property 12 months later, the market's moved 10%. So we've sort of made money from, you know, the money that we've put into it, but we've also made money from the market uplift, and we got that property valued at $720,000, which was an awesome margin. You can do that through a house and land strategy, and you can also do that through off the plan. That could be apartments or townhouses. So it's really important about picking that market, knowing that you're going to get that capital growth because you know that the migration's heading there, you know that the infrastructure is getting put in there, you know that the affordability factor's there. So for example, in Brisbane right now, you can get like houses that are, you know, 20, 25 Ks from the Brisbane CBD for 500 grand, right? Like, that's really attractive. Like, people come into my office all the time and say, look, I've got $500,000 to spend, what can I buy? And there's no way you're going to do that in Sydney. You know, in Melbourne, maybe 40, 50 Ks out of the Melbourne CBD, which it's a little bit better than Sydney because, you know, Melbourne's 5 to 6 years behind Sydney. But generally speaking, you know, like, Brisbane has that affordability right now. So where there's affordability and migration, because the rest of the market sees that, that's where the growth will occur, because people are flocking to that market and those asset prices will increase in value.
So let's go into then, I guess we know we want to get a good location. We want to get some capital growth in that asset. How do we go about distinguishing, do we buy a brand new property or something which is already established? And if we are buying brand new, one of our fundamentals is we have to have a cracker developer and builder. So can we break that down for the listener when we're choosing a property in our strategy, how we go about and why it's so important to have a good developer or builder on your side.
So let's start with brand new, right? Because we love brand new. Brand new provides better yields, better tax breaks, and also allows you complete control over the asset. So you can pick your floor plans, you can pick your finishes, and basically start from the beginning. So you're not buying someone else's problems or a floor plan that you don't like. You're starting from scratch. And because markets change, demographics change, locations gentrify, meaning that a new type of demographic will be living in that location, which therefore will command a different product, right? So by constructing brand new, we know we can study that demographic and feed that market what they want. Hence, the reason why we can get higher rents and higher returns. So with new, you want to pick a developer that is like a brand developer, or a builder that has a reputation to uphold. So someone that can offer lifetime guarantees, you know that you can call on if you have any problems. That's what you want. You don't want this dodgy Chinese developer that has this one-off development and then does the runner, liquidates their company, and then you just can't chase them up. You want to be dealing with people that have been in the game for a long time. They're going to be around in 20, 30, 40 years and be really proud of what they built and designed. So you want to make sure that you partner up with those people. Now, with established, still a great strategy, offers generally lower yields, less of a tax break, so not as attractive for investment. However, investors may need to turn to that strategy because they can't afford to do anything else, right? Because generally speaking, if you've got $500,000 to spend, you're very limited in your choice. But there's a whole bunch of established properties that you're able to get into. So for example, if you don't want to buy 20 to 25 Ks from the Brisbane CBD, a brand new house and land package for 500K, you may be able to come in a little bit closer, let's say 12 to 13 Ks, and buy an established property. But the problem we have with that is that we're buying an existing floor plan that's old school, that's already been done. Now you might stumble across a really great deal, and there's a lot of good deals out there, but these are the risks that are involved.
Definitely.
Right? But you also have development potential. You know, you also have renovation potential, and you've probably got a better block of dirt than, say, 25 Ks out from the CBD. So it's sort of like a balancing act. What's right for you? You know, what's right for you might be different for me, Dan, and what's right for the next person is different to all of us. So it's about our personal strategy, and it's about what you want to achieve out of it. It's not just the one property, because we're talking about building a portfolio of assets.
Definitely. And I think the beauty as well with this brand new is that you don't have to worry about the headache of repairs and maintenance. For example, one of my properties, which is established, you're always getting a phone call every year. There's the plumbing, the air conditioning, there's always something that will pop up where if it's something brand new, you may not have to worry about those ongoing problems. But then, like you said, with the established, I've got something where I can do a development on it and I can really manufacture some equity. So
it's the price you pay, right,
exactly,
Dan? It's the price you pay. So, you know, the pain that you go through with the broken toilets and, you know, the roof that needs repairing or whatever it is, and you've got to continually maintain this asset that generates you income on this scarce block of dirt, which is precious to us. We need to endure that pain until we decide to renovate or develop, right? So it's a give and take. You've got to really narrow down what's important to you, what you're trying to get out of it. We generally like to think that the new properties that we buy, we want to hold in our portfolio forever. The established properties, now if we don't further develop those in the future, we potentially will liquidate them to pay down and use the funds from there to pay down the debt on the new ones, because the new ones generally won't require all of that maintenance. They're not maintenance heavy, and that's the biggest advantage of that. And look, moving forward, if you've got established properties in your portfolio and they're older, like the ones that are built in 1940s and 50s and 60s, you're going to get rid of them. Otherwise, they're going to become money pits. Like, think about it. If you're going to be in the game for the next 40, 50 years, and you've got a property in your portfolio that's built in 1940, right? That property is going to be over 100 years old, right? And think about the maintenance that property is going to require at that point in time. Think about the low rental yield that you will achieve out of that at that point in time. However, you'll probably have a really good appreciation in the land value, but you want to do something with that. So either liquidate it and pay off some of your newer properties, or develop on it and build some townhouses or a duplex or whatever it is.
And that's a great way of explaining it. And say we do buy that established and we want to sell it to get something brand new, and we want to chase more of those yields. How do we go about finding? Why is it important to have properties that have good yields?
Well, like we said earlier, it's about maintaining that asset. So you've got costs associated with it, mortgage repayments, insurance, rates. Like, you don't want to be going to work paying for those things, especially when you don't live in the house, because we're talking about investing here. So it's really important to be getting the yields to uphold this asset while we build our portfolio. Because let's say, for example, we're in a negatively geared property and it's costing us, $1,000 a month. Now, in a year, that's $12,000. After a couple of years, that's going to get pretty old, having to fork out servicing this loan. Now, let's say you wanted to buy another property. You're probably roadblocked because the banks are going to look at you and go, unless your income dramatically increases, we can't lend you any more money. So the yield's really important. It keeps you in the game. It keeps you moving forward. And that's why it's really important to have this balance of capital growth and yield, because the capital growth will really build out your portfolio. It'll enable you to really get out of their rat race and really sort of, be on your path to financial freedom. However, to get there, you need that cash flow, which is like oxygen, right? You need that to keep moving forward.
So Zah, why is it then that some locations today might have good yield, but in 5 or 10 years' time, the yields drop? So for example, Sydney 10 years ago, you could get the yields there, but now everything in Sydney is so expensive and you're not finding the yields you might find in Brisbane or Melbourne.
Great point, right? We've found that Sydney yields have dropped, to about, what's the yield now in Sydney, 2 or 3%,
yes,
which is not really that bad when you think about it. However, we can outperform the market in other markets within Australia. Now, what generally happens is capital growth will increase, prices will increase. So for example, prices will go from $600,000 to say $1 million, but the rents will stay the same. So what happens is that percentage in the yield pulls away. So the yield drops. It goes from 5% to 3% or 4% to 2%, right? Because the growth of the asset, the value of the asset has increased that much that the yield hasn't caught up. And generally speaking, what happens is investors drive markets. So back in 2012, 2013, we had good yields in Sydney, and everybody knew Sydney was a blue chip location. So what happened was asset prices started to increase. And asset prices increase because investors see the yield. And when investors see the yield, they'll go and flock to that market. And then what will naturally happen, asset prices will increase and the yield will no longer be there, or the high yield will no longer be there. That's what's going to happen in every market. And that's what we call the property cycle. So that'll happen in Brisbane. That'll happen in Melbourne with the apartments that we were talking about. Eventually, those yields will start pulling away because those asset prices that are now $400,000 in 10 years' time will probably be $800,000 or $900,000. But the yields will start pulling away. And then what happens with those markets? Investors leave. Just like Sydney, investors have left and they're looking for other markets. That's basically what happens with the investor cycle in property. We're always looking for markets where we're going to get the attractive yield, but also be in attractive markets with blue chip locations that we know we're going to get that capital growth. So it's that balancing act of trying to get both. But one day, for example, Brisbane will become overheated. Capital growth will rise, yields will drop, and then all of a sudden we're starting to look for another market to put our money.
So how does a property cycle work, Zah? Because it's something we talk about a lot in real estate. It's a kind of a point that's spoken about quite often. So can you kind of give us an understanding of how it works in terms of the numbers from 12 o'clock, 3 o'clock, 6 o'clock, 9 o'clock, and how we can take advantage of each number?
Okay, so, let's imagine a clock, right? You've got 12 o'clock at the top and 6 o'clock at the bottom. Hopefully our listeners know how to tell the time so they can visualize this, right? 12 o'clock would be the boom, 6 o'clock would be the bust. And at the boom is the top of the market, right? And that's where Sydney was back in 2017. And as time goes on from 12 o'clock, it starts to decline. And that's where Sydney's pretty much is at the moment. It's probably at 3 o'clock. 6 o'clock is the bottom of the market, and that's where, things start to recover. And as you get to 7, 8, 9 o'clock, that's where the recovery starts to rise, right? And that's where you sort of want to be. You want to be at around 8 or 9 o'clock, even 7 o'clock before it actually starts, because that's where you're going to get that uplift. And, you can't time it and perfectly. We don't have a crystal ball in front of us. I wish we did. But you can time it, give or take maybe 2 or 3 years. And you can go with those trends and you can follow where the money is going to go. You just look at historical events, you look at the affordability, you look at the migration, and you look at where the demographics are heading. And, for example, Melbourne is 5 to 6 years behind Sydney. And, Sydney right now, everything's expensive. Houses, apartments, everything. What we want to do in Melbourne is that we know that Melbourne apartments are still quite affordable. So if we're 5 to 6 years behind Sydney, wouldn't it make sense for us to buy an apartment in Melbourne at 400 or 500 grand? Because we've seen apartments here in blue chip locations in Sydney go for over $1 million. I remember 10 years ago where apartments in Bondi Beach were like 500 grand. Now those apartments are over $1 million. That's where we're at in Melbourne. So if we can sort of track that trend and then park our money into those markets, into those asset types that are going to rise in value after the recovery, then it makes sense. It doesn't make sense to jump in when everybody's there, right? It doesn't make sense to jump in when you're at 12 o'clock at the top of the cycle, right? It just doesn't. You want to get in low while the yields are there and also while the prices are down.
Exactly right. So I guess then we've kind of talked about the fundamentals about what we can look at when we're buying a property. Let's talk now about when and how do we know when to buy an apartment? When and how do we know to buy a townhouse or house and land? Because I think that's something that a lot of people get caught up in, and they don't. And there's a general rule of thumb of each asset itself can perform differently.
So it's interesting, right? Because there's so much debate over houses or granny flats and apartments and townhomes and villas, and everyone has this strategy which they believe that works, or an asset type that they believe in that works. Like, I know a lot of people that hate apartments and they just go, oh, then they hate townhouses as well. They just hate the strata costs that are involved with it. They just want land. They go, oh, land's the only thing that's really going to appreciate in value. The building, is always going to fall apart. And they've got this belief system, right? And look, they're not wrong. They're not wrong. But also, they're also focusing on negatives that are associated with apartments and townhouses, where there's a lot of positives. Now, if it was all negative, then they wouldn't build apartments. If it was all negative, we wouldn't have townhouses, right? There's obviously something good about them. So let's find out what it is and add it to our portfolio. I truly believe it needs to be a diverse set of asset types within a portfolio. Mix it up. Apartments, townhouses, houses, developments, like have them all, because they all have good attributes. So for example, if you had $500,000 to spend and you had to pick between an apartment or a house, then you're going to get a better located apartment than you are with a house. So location might be your first step. So if location's your first step, then you're going to go for an apartment, because you're dictated by your $500,000 budget, right? Now, if you want say, more of a capital growth play because that's what's in the land, then you may go towards the house and land, maybe 20 k's out from the Brisbane CBD. So it all depends on your situation. If you're needing the yield and you're after that location play, then maybe the apartment makes sense. If you're after that capital growth and you want that land content, then maybe it is the house and land, right? Now, what if you just wanted a really good investment, something conservative that gave you a really good return, had a bit of capital growth thrown in there, and it also had that location play? Then you could go in the middle at the townhouse. And that's what makes townhouses so cool, right? Like you've got land content, or most of the time if you pick the right one, but you've also got the apartment attributes of having that higher yield. So it all depends on, obviously, location, developer, all of those things, you know, play a part in the selection process, but they're all great. Apartments, townhouses, houses, they're all good. They all have a place in your portfolio.
Definitely. And I think on townhouses, a great thing about them is that they're built in established markets, right? Where you don't get a developer going out west and buying all this land and only putting townhouses. Usually you'll see an established location where they've already built the houses, and then the next best thing they could build is townhouses. So actually you can get in a better location, like you're saying, and still get that land content with a townhouse. So I think for a lot of listeners moving forward, a townhouse is probably one of the best asset classes you can invest in. But a lot of people shy away from them because they don't think they could live in there themselves. So it's a funny thing, isn't it?
Well, it's funny because how you say that a lot of people can't think that they'll live in them themselves. Like I could actually see myself living in a townhouse. Like right now I live in an apartment, but I could see myself living in a townhouse because it has the convenience of living in an apartment, but it also has the space and the room that you would get out of a house, and it's low maintenance as well. Like I don't think people really want the big backyard anymore. I mean, a yard's important, I get it, but maybe just a courtyard, right? You don't need that high maintenance because all you do is end up doing the gardening, mowing the lawns, you know, and then you've got to paint the house again and all of that sort of thing. It's just, it's a pain, right? I think townhouses are going to be the next biggest thing because like you said, Dan, you can be in those really good locations, right? You can have less of a maintenance responsibility, and essentially what's going to happen is you'll get capital growth because you're in great locations. You've still got a little bit of land content. It's an awesome play. Like we're getting, and you said something really interesting as well about the developers. They're not going to develop out in the sticks, right? Because the demand's not there for that. So if you follow a really good reputable developer, you can know that they've done a lot of research on that area because they're not going to build on something that is not going to make money. They have to make money, and their brand's associated with that. So they don't want that to fail. They want that to grow in value. They want us to talk about them in 20, 30, 40 years' time and say that we made the right decision. So I think townhouses are a great investment option. So Dan, have we got anything else that you wanted to cover today?
I think we might wrap that up for today. We've done a big one today. I think next time we can go into a bit more specifics of what locations we recommend for an apartment, for a townhouse, and for house and land. So I think if we can take away some of the fundamentals we learned with developing the right psychology, knowing our plan, where we want to be in 10, 20 years time, getting a good team of experts, but also property selection. We take the Luxland fundamentals of the location, capital growth, builder and developer, the yields, and also the property cycle. I think if we can take that and move it into next podcast, and we can really go deep into which locations we recommend for each property type.
Sounds good. I look forward to it. Thanks for listening, guys. See you next time.
See ya.